How much home can you afford to purchase if you make $100,000 per year? Well, that's exactly what we're going to dive into in today's video. We're going to use a $100,000 salary using an FHA loan. And the reason we're talking FHA is because FHA is the most lenient program out there when it comes to qualifying for a home. It allows you to have more monthly debt on your credit report and still qualify for the most amount of property. Now, I'm also going to go over a conventional scenario in this video as well, just to give you an idea of how it compares. But if you make $100,000 per year and you're considering using an FHA loan, this video is going to give you a really good idea of how much home you can afford to purchase. Now, one thing I like to be very, very clear on early in these videos is that this video is really for novelty purposes only. It's kind of a back of the napkin calculation, if you will. Don't run the numbers yourself, take those and go out and say, hey, I'm pre-approved up to this amount because I watched a video. Rather, make sure you're speaking with a mortgage professional. Let them look at your credit report, let them look at your tax returns and actually run some real numbers based on where interest rates are that day so that you know you're fully approved and ready to go out and buy a home. Now, if you're watching this and you have no idea where to start, well, I actually put a referral link in the description below so that you can work directly with me and my team where we will actually guide you through this process. Now, there's absolutely no pressure to do that, but just make sure whoever's running the numbers actually knows what they're talking about so that you're not making offers on a home where you're actually not qualified to buy the home. But with that, I want to point out a couple of things in order to start this video. We're doing an FHA loan. We're assuming you're putting only 3.5% down, which is the minimum that FHA requires as long as you have a 580 credit score or better. Now, FHA does allow credit scores as low as 500, but the caveat is they require a down payment of at least 10% versus their minimal down of 3.5%. And another thing I want to note on FHA is not only for first-time home buyers. You can be a home buyer that has purchased multiple homes. In fact, you can own another home right now and still use FHA to qualify. And along those same lines, FHA is not just for those with lower down payments and lower credit scores. Yes, it allows them, which leads a lot of people to believe it's only for those types of borrowers when that's simply not true. Anyone can use an FHA loan at any time. So if you're going through the process and you're unsure of which type of loan program you want to do, just have the lender that you're talking to give you side-by-side comparisons of all the loan programs that you qualify for. That way you can decide which loan program is right for you versus someone telling you which loan program is right for you. Now that we got all of that cleared out of the way, let's talk about how much home you can actually afford if you make $100,000 per year. Now, I did this video back in 2021 when interest rates were at 2.5%. In fact, someone recently commented on that video and said, hey, why don't you update that video and do it with today's rates at 7%? And that's exactly why we're doing this video. And the numbers are considerably different from when they were back then. In fact, back then, you could purchase almost a $700,000 home with just 3.5% down, making $100,000 per year. That's going to be a lot different than the numbers you're going to see today. But with that, I want to walk you through the entire process so that you can do the calculations on your own to give you a good idea if you're doing this at home. The very first thing we want to do is take your salary. Let's say that you make $100,000 per year. We're using your gross salary before any taxes come out. Now, I realize you have taxes come out. I realize you might pay money into a 401k. You might have a deferred comp. You might have other things where your money's coming out. Quite frankly, the lender doesn't care about those numbers. They're just using your gross monthly income. And the reason they're doing that is because different people have different exemptions. They take taxes different ways. So the way to keep it the simplest, if you will, is to use the gross. They take that gross, in this case, $100,000, and they divide it by 12 because there's 12 months in the year. Well, that gives us a gross monthly salary of $8,333 per month. Now, the very next thing we need to do in order to determine how much home you can afford is we need to figure out your debt to income ratio, because your debt to income ratio is how a lender determines how much money they'll actually lend you. And when it comes to your debt to income ratio, it's exactly what it says. It's your monthly debt compared to your monthly income. And with that, there's a front end ratio and a back end ratio. The front end ratio is just your housing expenses, whatever is associated with the house you're looking to buy. So typically speaking, you have principal and interest payment, you have property taxes, you have homeowners insurance. In the case you're using FHA, you also have monthly mortgage insurance, PMI. And some other things that could be added to that are things like an HOA. If you're buying a property in a homeowners association, that fee would also be included. But for today's example, we're not going to use that. Now that's our front end ratio. Our back-end ratio is all of those housing expenses we just mentioned, plus whatever debts show up on your credit report. These are things like your car payments, your credit card, things like installment loans. If you go out to apply for furniture, anytime you apply for credit, if you will, that stuff typically reports on your credit report. Those are the debts that we're taking into consideration, anything that shows up on your credit report. Now, we're not taking into consideration how much you spend on groceries, how much you spend on daycare, how much you spend going out to dinner per month. None of that is factored in. That should be factored into your monthly budget, which you've determined how much you can afford, but the lender is not actually looking at that when they determine how much home you can actually afford. So in the case of FHA is the most lenient program because they allow you to go up to a 47% on your front end ratio. So that is your housing expenses. And then they allow you to go up as high as a 57% in some cases on your back-end ratio. That's your housing expenses plus all of the other monthly debts. Now, one thing I do want to point out here is if you're stretching these debt-to-income ratios, you need compensating factors. You can't come in at the bare minimum and have a 580 credit score and just be putting 3.5% down and look to go to a 57 back-end ratio. Chances are you're probably not going to qualify. Now, on the other hand, if you have a 700 credit score, you're putting 3.5% down and you're trying to get up to that 57%, in that case, you might actually be able to make it happen. Now, I know some people watch this and go, well, Jeb, I'm meeting the minimum qualifications. I have a 580, I have a 3.5% down. Why aren't they allowing me to 57%? Well, that's because that's their bare minimum qualifications. Not everybody is going to get that. In fact, maybe no one gets that and actually gets the higher end ratio. And that's why it's super, super important when you're watching videos like this that you are talking to a mortgage professional, having them look at your income, especially if you're self-employed, because there's so many different variations and calculations that can be used and things that can be written off in order to determine how much income they're actually going to use. So instead of trying to do this at home, talk to a pro. As I mentioned earlier, if you want to work with us and our team, there's a link in the description below. But in the case of today's video and using that $100,000 salary, we determined that our gross monthly income is $8,333. Well, 47% of that, which would be our front end ratio, our max housing expenses, would actually be $3,916, which means our housing expenses can't exceed that $3,916. But our back-end ratio, that's our housing expenses plus those debts, can actually go up to $4,749. Now, some people watch this video go, I don't have any monthly debts. I don't have anything. I'm just going to have a housing expense. Can I stretch that back-end ratio? Unfortunately not. If you have no other expenses, your front-end ratio and your back-end ratio are essentially going to be the same number. But in the case that you are able to buy a home and your max debt-to-income ratio on the front is maxed out at $3,916, that means you could have $833 in monthly debt and still meet the qualifications per FHA guidelines. But let's do some real number calculations. Let's talk about purchase prices. As I mentioned, back in 2021, we were looking at being able to qualify for a $700,000 home because interest rates were at 2.5%. Well, today, if I use those same calculations on a $700,000 home where FHA rates today are somewhere around 7%, that payment with everything included, taxes, insurance, everything, which I'll break down what those are in just a minute, would be $5,679. That's more than our front and our back end ratio. So there's no world today which you could qualify for that FHA loan at $700,000 just putting 3.5% down because interest rates are so much higher than they were back then. In fact, it's going to take us down to a number closer to $450,000. And I'm going to break that down right now. So if you're buying a $450,000 home and you're putting the minimal down with FHA, that means you're putting 3.5% down, which is a down payment of $15,750. But here's the caveat. FHA actually has something called upfront mortgage insurance that they require on every single FHA loan. Regardless of how much money you're putting down, it's required. Doesn't matter your credit scores, doesn't matter anything. Every single person getting an FHA loan has this upfront mortgage insurance premium. And in the case of FHA, it's 1.75%. So we take that $450,000 purchase price, we subtract our down payment of $15,750. That gives us a base loan amount, $435,000. $434,250. But we have to add that upfront mortgage insurance premium back. So we take that number, we multiply it by 1.75%, which gives us a number of $7,599. That's the amount of the upfront mortgage insurance premium. Now, we add that back to the $434,250, which gives us a base loan amount of $441,849. So that's the amount that we're actually financing. Now, you can choose to pay the upfront mortgage insurance premium out of pocket through closing if you want, but because FHA does allow you to finance it, most people finance that amount, which means you'd be financing that $441,000 loan amount. Well, as I mentioned earlier, today's interest rates on FHA are somewhere around 7%, which means your mortgage payment would break down to $2,940 per month with just the principal and interest payment. Now, on top of that, you're going to have property taxes. Depending on where you're located in the country, that number is going to vary. Now, the nationwide average is 1.1%, which is what I'm going to use today, and pretty realistic for where I am here in California. But if you go to states like Texas or Florida or New York, that number can be 2.5%, which means the property taxes are going to be significantly higher. So just make sure you're using the calculations for your area. But at 1.1%, that breaks down to $413 per month. Now, in addition to that, you're going to have homeowners insurance, which covers fire, which covers theft, that sort of thing. We're going to estimate that to be somewhere around $100 per month or $1,200 per year for a $450,000 home. But there is one more fee that we have to calculate. That is the monthly mortgage insurance. So not only do you have the upfront mortgage insurance premium, all FHA loans have a monthly mortgage insurance premium as well, which is 0.55%. Now, regardless of the type of loan you're doing with FHA or how much you're putting down, what your credit scores are, you're going to have that 0.55%. Now, it stays on the loan for the life of the loan, unless you put at least 10% down. If you put at least 10% down, it will fall off automatically after year 11. Now, if you don't put 10% down or at least 10% down, it's going to be there for the life of the loan, regardless of how many years you have the loan. For 20 years, it'll stay on the loan. It doesn't matter how much equity you have. It's one of the downsides of FHA. But in the case of an FHA loan at 0.55%, that amount is $202.51 per month. So once we add everything up, you're going to have a mortgage payment of $3,655. That's going to fall beneath the 47% front-end ratio that we mentioned earlier, because that number was $3,916. So in this case, we've met the front-end ratio. And in fact, you could have monthly debts totaling up to $1,094, almost $1,100 per month, and still qualify using an FHA loan, because you add that amount to your front-end ratio and you would still be under that 0.57 on the back. So you could have a car payment of $750, you could have a credit card of $200 per month, and you could have student loans of $100 per month, and you would still qualify. Now, if your debt exceeds that $1,094 per month, then chances are you're going to find it very difficult to qualify for this $450,000 home. You might actually need to go down in purchase price. In fact, if you had monthly debt at $833 or less, you could probably push this purchase price up to $475, $480, maybe even $490 in some cases, and still qualify if interest rates stayed at 7% or below. Now, if FHA rates continue to move down, which they probably will in the future, you're going to be able to qualify for more home in this scenario. As I mentioned earlier, I did this video back in 2021, and you could qualify for up to $700,000. It's $250,000 less than back then, because interest rates have nearly tripled since that point. Interest rates have a huge impact not only on your monthly payment, but how much you can afford to purchase. So as that number comes down, you're going to be able to qualify for more home. Now, earlier in the video, I mentioned what it would look like with a conventional loan. Conventional loans are a little bit more strict, if you will. They require lower debt-to-income ratios than what FHA typically allows. Now, with that said, if you have below a 680 credit score, chances are FHA is typically going to be the better loan program for you, because of some of the hits that you have with mortgage insurance and other things when it comes to conventional loans. Now, on the flip side, if you're buying with a conventional loan, you have very, very high credit score, say above 780, and you're putting, 3.5%, 5% down, conventional loans typically are going to look a little bit better, because you're not going to have that upfront mortgage insurance premium, which essentially takes some of your equity, if you will, by financing that amount. So conventional, in many cases, can be a better loan program, but you have to have really high credit scores so that it adjusts on the mortgage insurance. Now, with conventional, their guidelines typically allow somewhere between a 45% or maybe even as high as a 49% on your back-end ratio, which is a little bit different, as we mentioned with FHA, that allows you to go as high as 57%. So if you don't have a lot of debt and you have really high credit scores, then you may want to consider using a conventional loan. Now, as I mentioned earlier, when you're going through that process, you're having that conversation with your lender. Just make sure they're running numbers side by side. They're showing you conventional, they're showing you FHA, assuming you qualify for both. And that way you can see, oh, this is how much money I need to bring in. This is what my monthly payment is. This is essentially how much equity I would have from the get-go if I'm paying that upfront mortgage insurance premium, or if I'm not. That way you can make the best decision for yourself. Now, maybe you're watching this and you're going, Jeb, I don't make $100,000. I actually make less. Well, I created this video here to guide you through that process if you have a lower salary. So check it out. Let me know what you think.